Investors are always looking for ways to improve their returns, but most ignore the biggest drag on their portfolio: fees. This video is all about why investment fees matter. The first reason is that fees compound. Just as your investments grow through the magic of compounding, fees also compound just in the opposite way. They compound against you. And that's why a seemingly tiny 1% annual fee can cost you hundreds of thousands of dollars over a lifetime of investing. For example, if you invest $100,000 and earn 7% annually, well, after 30 years, you'd have $761,225 with no fees. But if you're paying just a 1% fee, 1%, like that doesn't sound like very much at all, right? But if you pay a 1% fee, your return drops to 6%, leaving you with only $574,349. That's a loss of $186,876 thanks to fees, thanks to a measly 1% fee. The second reason that fees matter is that they eat into your returns, even in a good market. Market returns are unpredictable, but fees are guaranteed, a guaranteed drag on your portfolio. Whether the market is up or down, fees get deducted no matter what. And you may not notice it, especially when the market's going up, because your returns seem good, but they could be even better if you didn't have that fee or if you had a lower fee. The third reason that fees matter is that active management rarely justifies the high fees that they charge. Many mutual funds and actively managed ETFs charge higher fees than your standard index fund, but most actually fail to outperform low-cost index funds over time. Studies show that low-fee index funds consistently beat most actively managed funds after accounting for fees. Consider Warren Buffett's famous bet known as the $1 million bet. This was a 10-year wager that he made back in 2007. The bet was this: Buffett bet that a simple S&P 500 index fund would outperform a group of actively managed hedge funds over a decade. So it was Buffett versus hedge funds, and Buffett chose Vanguard's S&P 500 index fund as his pick. Protégé Partners, a hedge fund firm, took the bet and selected a portfolio of 5 hedge funds. The stakes were $1 million, with the winnings going to charity, and the bet ran from 2008 until 2017. The outcome? Buffett won easily. His index funds returned 126% over the 10-year period, while the hedge funds, after fees, returned 36% on average, massively underperforming Buffett and his simple index fund.
The world's richest man just won a 10-year wager that he had with a top hedge fund manager. Warren Buffett bet a cool $1 million that his S&P index fund would perform better than a group of funds selected by that fund manager over a decade of time. And he was right. He's now donating that $1 million to a girls' charity in Nebraska.
The lesson? Well, Buffett made this bet to prove a key point. Most investors are better off with low-cost index funds instead of trying to beat the market with expensive hedge funds or any kind of actively managed approach. The fourth reason that investment fees matter is that they add up across multiple layers, and they're sneaky. Investors often pay multiple types of fees, including expense ratios, sometimes called fund management fees. They pay trading fees, sometimes explicitly in the form of commissions, and other times more sneakily in the form of bid-ask spreads. They pay advisory fees if they're using a financial advisor. They pay 401k plan fees, which are often hidden but still impactful. And the final reason that investment fees matter: reducing fees is one of the few investing moves that is fully under your control. This is a huge concept to grasp because while you can't predict market returns, and you certainly can't control what the market does, you can control how much you pay in fees. And choosing low-cost index funds, like those offered by Vanguard, Fidelity, or Schwab, well, you're often going to pay less than 0.1% in fees. In Vanguard's case, Their most popular index fund ETFs, like the ones that Buffett used for his bet, are down to 0.03%, rock bottom prices, and Fidelity even has their lineup of zero funds with zero expense ratio, zero fee whatsoever. Compare this with a more expensive, actively managed fund, which might charge upwards of 1% in fees per year. Well, by choosing funds with lower expense ratios, lower fees, you can keep more of your money working for you, and at the end of the day, you'll probably outperform most of those expensive actively managed funds. The bottom line is that every dollar spent on fees is a dollar that is not compounding for your future. And keeping fees low is one of the easiest and most effective ways to maximize your long-term investment returns. I would say between fees and tax efficiency, those are the two things that are really in your control for investing to maximize your returns. And for a small investor, a seemingly small difference in fees may not feel huge right away, but over decades of investing, it can definitely add up. And at the end of the day, lower fees means that you keep more of your investment returns, and who doesn't like that? That's what I have for you in this video. Be sure to like, comment, subscribe, and check out this video next, which one of my viewers called the best advice I have seen on stock investing. Wow. Thanks, man.